Welcome to The Explainer. We always think about companies facing threats from the outside competitors, hackers, you name it. But what about a threat that's already inside? Today, we're diving into the clever systems companies build to protect themselves from their own people. So let's just cut right to the chase with a really fun question. It sounds a little crazy, but it gets to a very real problem. How do you actually stop an employee who has access to the company's money from, buying a Ferrari with it? And the truth is, a lot of the time, the biggest risks are the ones you don't see coming from the outside. But the solution isn't what you might think. It's not about putting cameras everywhere or watching every move. It's actually about a really smart, almost elegant system of defense. We call it internal controls. All right, so let's get into it. The core of this entire defense system, everything we're about to talk about, it really boils down to one single brilliant idea: making sure no one person ever has too much power. Okay, so here's the key concept. It's called segregation of duties. And for our Arabic-speaking audience, that's fasl el-maham. Now, the principle behind it is actually surprisingly simple. You just never ever let one person have control over a financial transaction from start to finish. Instead, you build a human chain. So, think about it like this. Every big transaction has three key parts, right? First, you've got the person who authorizes it, the one who says, yep, we should do this. Then you've got the person who has custody of the actual asset, the one who can physically handle the money or the inventory. And finally, you have the person who records it all in the accounting system. The whole goal? Make sure these are three different people. And this slide just lays it out perfectly. On the left, you've got one person trying to juggle everything. That's a recipe for disaster, right? It's so easy to make a mistake or even to cheat. But on the right, when you separate those duties, you create this natural defense. Now, to beat this system, you can't act alone. You'd literally have to convince your coworkers to conspire with you. Okay, so that's the theory. But how does this actually work in the real world? Let's follow the money and trace the anatomy of a simple purchase to see it in action. Okay, check out this flow. The whole process kicks off when the warehouse team realizes they're low on something. That's step one. But notice, they don't place the order themselves, they just request it. Then, the purchasing department, a totally separate team, they're the ones who approve it and officially order it. After that, a third department, receiving, accepts the delivery. And finally, a fourth department, accounting, is the one that actually pays the bill. See? No single department controls this thing from start to finish. Now, here's a really cool, kind of clever little detail in the system. The purchase order that gets sent to the receiving department is often what's called a blind copy. That means the quantity is left blank. So why would you do that? Well, it forces the receiving team to actually count what shows up instead of just looking at a number and checking a box. It's a simple but absolutely brilliant way to enforce accuracy. And this brings us to the one's crucial point, the final checkpoint. Before a single dollar gets paid, the accounting department does what's called a four-way match. They take all the paperwork and check that what the warehouse asked for, what purchasing ordered, what receiving got, and what the vendor billed for all line up perfectly. If even one of these doesn't match, payment is stopped, dead in its tracks. So that same logic, that same idea of separating duties, it applies to every part of the business. It even works when the company makes money through a sale. It's really the same core idea, just running in reverse. And you can see the pattern here again, can't you? The sales team, they can take a customer's order, but they can't approve selling on credit. Nope, that's a job for the credit department. Then, the shipping department can handle the actual goods, but they're not the ones creating the bill. And finally, the accounting department records everything, but they never touch the product or approve the credit terms. Everybody stays in their own lane. This table just sums it all up beautifully. It doesn't matter if it's a purchase or a sale. The principle is identical. You always have one group for authorization, they approve the deal. Another group has custody, they handle the physical stuff. And a third group handles the recording. They log it all in the books. It's this really consistent, really powerful framework. Okay, so this whole system seems pretty airtight, right? With all these different departments and matching documents, it feels foolproof, but it's not. There is one critical weakness. And to understand that weakness, you have to remember what this whole thing was designed for in the first place. It's built to stop a single individual from causing harm, whether it's by accident or on purpose. But what happens if it's not just one person? What if the different links in that human chain we talked about decide to work together instead of checking each other? And this brings us to the final and most crucial question of all. If these controls are so strong, how do we still hear about these massive corporate frauds? The system is designed to stop one person, but what happens when people decide to conspire? The answer is just one word: collusion, or tawatul in Arabic. When the very people who are meant to be a check on each other decide to work together, the entire system can just collapse. It is the ultimate vulnerability. And it's a really powerful reminder that no process, no matter how perfectly it's designed, can ever fully replace human integrity. So it leaves you with a question, right? What do you trust more, a clever system or good people?